What's up, guys? My bad. The day we get this nice trade setups, that's the day I have to deal with something else. Let me start recording this. All right, good morning, guys. Today is Tuesday, October 3rd. And as usual, we'll be doing analysis
It's no volume, bro. I just looked at the screen. I didn't know you was even talking until I looked at the screen.
Volume?
Now there is.
Okay. Also, I don't know. Oh, and looks like also give me 1 second. It's not using. Yeah, I know my computer is going crazy too. Why is it not picking up this microphone? Because I'm guessing y'all can even tell the microphone quality is probably has some echo. Give me 1 second. Oh. Let me see. So right now, okay, so it should be picking this microphone that I have right now. So let me know if this is better. Okay, so this one should be good. Yeah. Yeah, everything is tanking. But I see gold going to the 1800s. So here we go on gold and go to the daily time frame, and this is the reversal indicator on the daily. You'll see that gold is headed like where gold is right now. If gold breaks this, and I'd sent this in the Discord a while back, or not a while back, just I think last week, and I said gold was headed to 1830, 1810 area. If gold breaks 1822, we're going to 1800, and at 1800, other than a psychological level, gold is going to fall if it breaks below 1800. And if you look at the overall, look at this. It's a major thing to wish for or even to look at. But if you're looking at structure, gold can come down to 1600s right there. And if we look at what's going on in the markets, nowadays, you can see looking at it, and this is the importance of just sticking to your daily bias. And speaking of daily bias, let me see how my sales on this account, I think they're still going. But anyway, here, looking at this, or the DXY and the dollar is still pushing. So I know there's, looking at fundamentals, like worldwide fundamentals, you have the BRICS, which is, I think, I forget which countries those are, but I know India is part of that. Brazil, I don't know what the R is. Brazil, India, South Africa. I don't know what the R and C,
Russia.
which countries? Russia. What's C?
See,
China. Yeah.
Yeah.
So they're trying to, change or create a quote unquote new world order. And change, move away from the US dollar and make payments using their country's currency. So I think what the US is doing, they're propping up the US dollar, because the more the US dollar is propped up, if you try and say pay for a commodity or pay for oil using your South African rand or the Chinese yen, of course, it's going to be less valuable than the US dollar. So of course, suppliers will prefer the valuable currency. So suppliers will start asking for payments, even from these BRICS nations in the US dollar. So I think that's what the US is doing. They're like, okay, if you guys think that you can outdo us or devalue our currency or start making payments. And keep in mind, even worldwide, most of the loans that countries are given, they are given in US dollars. Because if you're given a loan by the IMF, or by the World Bank, you're not really given, your country might report, okay, we received 200 billion rand or whatever, but the actual loan is given in US dollars. So you have to pay back the loan, not in the rand, but in dollars. So for a new world order, I think that's going to come, maybe not in our lifetime, but maybe in another 100 or 200 years. But I think during our lifetime, the US dollar will still remain king. I don't think there's any other currency that will outdo the US dollar. So I think what the US right now is doing, it's using its might, its financial might, to say, if you guys think that you can overtake our US dollar, you guys have another thing coming, and the US literally has a lot of financial instruments to keep pumping. They can even push the US dollar to 200 value if they wanted to, because they have the financial might to hold even in losses or in drawdown. So think of it like if you're trading like $1 million account, like if you're literally trading $1 million account, you can open 100 lot on US 30, 100 lot buy right now on US 30. And if you know that US 30, since US 30 is a directional asset, and you know that in future, in another year, in another 2 months or 6 months, US 30 will trend back up, you can buy, if you had $1 million account, you can buy 100 lot on US 30, and you have like a 90% probability that you're not going to blow the $1 million, right? So think of that in the same analogy with the US. So the US knows that, hey, we have unlimited resources, and if we wanted, we will still keep pumping up the US dollars, and we will squeeze out these other people that think that they can use their own currencies to pay for supplies. So the US dollar can keep pumping for another full year. And then what will happen to these countries is that the suppliers for oil or for other instruments, they'll be asking for US dollars and not the Chinese yen and not the South African rand. And then at some point, they'll just be squeezed out and be like, okay, we'll give in, we'll start paying. We'll resume our payments using the US dollar and not our local currencies. So I think that's what happened. That's what's happening with the US dollar. And looking at this, honestly, I wouldn't be surprised if gold goes down to 1,600. Now it doesn't have to, I'm not saying it's going to drop in 1 week or five weeks, but if gold breaks 1809, 1800 is not going to hold gold. The next value for gold is 1730 around here, and possibly 1629. And if you guys remember, we were on the live session. I remember that you guys remember that one time when gold was at 1812, and I was like, gold from 1812. And I remember that was one of the first, during that first month when I started GA Trading Club. And I know we hadn't started doing the daily recordings or daily whatever. Actually, no, I don't know what I had started, but I remember calling a buy on gold at 1812. And from then on, gold skyrocketed from 1812 to 2060. So I think that gold is headed to the 1600s, maybe in another few months, but we will see about that. So I'm sorry, guys, for that US 30 sell. I missed being on the live session by literally like 3 minutes. But I was waiting on that sell for US 30. But anyway, we just have to. I haven't traded for like 7 days. Because if you guys even go to the Discord, the last time I posted a profit was September 19th. So unfortunately, we missed that sell on gold. So we just have to wait for another one. I'm sorry, sell on US 30. Gold here, we do have that double SAR on the 30-minute, but you can see gold is rejecting back up. EU, nothing really for it. So I don't have anything else. So I don't want to keep you guys on here. So if you guys have any questions, feel free to ask. But I would just say, whatever you're doing, just keep looking for sells. And you guys know me, right? The only time I'll catch a buy or start looking for buys is if we get a closure on the daily for a buy SAR. And I think when that does happen, things will start pumping, and it will be, especially for EU, because EU compared to even gold and US 30, EU has been trending down the longest, right? Since this high right here on July 23rd, July, August, September, June, July, August, September, October. For about 3 months, possibly. So let me know if you guys have any questions. If not, we'll have to wait for tomorrow. But I'm just pissed we missed that US 30 sell. We could have had a nice no drawdown trade and a nice 1.5% gain. So let me know if you guys have any questions or anything you want to go over. For the EA, still waiting on that minor tweak to be made by the programmer. It is, I'm hoping that tweak, I know he said 3 to 5 days. So today should be, because he gave me that message on Saturday, Sunday, Monday, Tuesday. So today should be day 3. So hopefully have some feedback from him soon, because what I'm waiting on, I'm hoping we have the EA in time to catch the buys on gold. So we're still, we're not missing anything. And as much as I have that account that's still entering the sells, I know I'm pushing it right now. So when we do have everything, and in case, this is for when we do have it, ideally I'll just be using the daily bias. So it's upon you guys. So nothing changes. So remember, this EA is built off of my logic and everything that I teach you guys or I go over with you guys. So remember, do not trade hours of consolidation. Do not trade hours of low liquidity. Use the daily SAR for your bias. If you want to trade both buys and sells, the EA is programmed for that, and it can manage the trades. It can close out trades from opposite trends. But you will have a higher win rate if you choose to trade like I do and just trade either buys only or sells only. So after that minor update, so hopefully we get it. So we're not really missing anything. So, and you can see even a buy SAR hasn't been printed on the daily. So we are in good time. And right now with the no time frame or no, what is it called? No time limit on prop firms. Because right now what I'm struggling with is when is enough? Because right now I've banked, I think right now it should be at 5%. Let's see. Because my computer just chooses to freeze every now and then. Yeah, I'm at 4.5%, and I made what is it, $600 today. Let's see for this one. Let's see, is it gonna? Nope, still frozen. But if you guys see this, hopefully you guys can see. Oh, it's a bit blurry, but 600. So I'm at 4.6%, and that's on a 100K account. So I think the logic, when I do release this, the logic will be like for each trend, for each bi-directional trades, we shoot for like 3%. If we gain that 3%, we hold off and maybe find another asset to trade. Or if you want to push it, like right now I'm pushing it, I shouldn't really be pushing it. I should just turn it off and wait for the buy momentum. But I normally tell you guys, greed gets the best of us, but it's not really being greedy. What I'm trying to test is before that buy comes in, like how am I going to manage the sells that are open? So that's another reason why I'm still pushing the sells even as it's trading right now. So we'll see. But when my programmer gets back to me, then I'll find an avenue to release it to you guys. So there's a couple of different avenues. Of course, there's the one where I can give you guys a link to directly download it. There's the other avenue where I can put it on market, the MQL5 market, and put it as free. And for the MQL5 marketplace, like for example, for you guys who use the trade manager that I do, you know that you had to sign up an MQL5, it's a free account. So you had to sign up for an MQL5 account, and then you had to go to the marketplace on MQL5 and buy that EA. This is the trade manager one. So on that MQL5, I can still put the EA as free. So you just access it from there, and it's tied to your MQL5 account. So there's both pros and cons for either giving it to you guys directly as a download, or just using the marketplace. So, but we'll see. But anyway, it's still gonna be free. So I just have to also figure out a way to deliver it to you guys. But that's pretty much what I have going on for me. No trades for today. That sell went too quickly. So let me know if you guys have any questions before we call it a day.
Okay, well, just three things. Okay, so the first thing is, let's see, yeah. So with the SARs, I've been testing it. Sometimes when we look at the double SARs, how far should the SARs be from each other for it to be like tradable? Because some of them they're like 30 pips away from each other. So would that be considered tradable?
No, so it depends on your stop loss, right? So for gold, for me, I have a 30 pip stop loss, but my rule of thumb is SAR should ideally be at most 10 pips away from each other. You can, and at the very least for gold and and FX pairs. For US 30, you can what is it called? For US 30, you can get away with having like a 20 pip gap between SARs. So let me give you an example here. So you see, and some of them will just scream out at you. So and maybe you guys have seen me do adjustments on the live session. Let me try and delete this. Okay. So here's an example. 33,400. So one idea can be this can possibly be a triple SAR just by looking at it, right? But the top one is at 33,447. The bottom one is at 33,373. So that is a 70 pip zone. So of course, that wouldn't be a good triple SAR. But if I remove this, what other ones do you see that are close together? So this one is far away from this two right here. But what about this two? So for this two, this one is 33,404. This one is 33,777. So it's about a 23 zone, 23 pip zone. So I would consider this a double SAR. So this is US 30. For me, US 30, my stop loss is 50 pips. So at right. So that's the difference. So if you and I get again another better way might be to zoom out a little bit, because if you zoom out a little bit, you will see the ones that are ideally close together. So you can see that example I gave. Instead of a triple SAR, you can narrow that down to a double SAR. Yeah, so that's how you distinguish. But ideally, even if for US 30, and US 30 will also give you like 10 pip SAR. So if at least when you're starting, start off with a 10 pip zone for all instruments, whether it's US 30, gold, or FX pairs. And as you trade them, you'll start seeing those adjustments you can make to bring in a triple or to bring in a quadruple. But most of them, ideally, even for me, when I'm identifying triple, all of them, even though I zoom out or zoom in, they'll still be close to each other. And even if I'm trading a quadruple or a quintuple, which is 5, US 30 can literally give you a quintuple, and you'll see that, and which is why I don't extend on the 1 minute. So for example, right here, you see if I extend on the 1 minute, this can be literally a quintuple or whatever. I think this is 8, because the top one is 468, the bottom one is 445. So think of this if this was on the hourly time frame. Right? If this was on the hourly time frame or 15-minute time frame, I would consider this 1, 2, 3, 4, 5, 6. It would be a sextuple sell SAR zone, because the top one is 33,468, the bottom one is 33,445. So that I would consider a sextuple. But even in that sextuple, you see there's some SARs that are close together. So I can break this down to a triple, and I can break this down into a double, because you can see that top one, as much as it's close to these others, if you zoom out or look out, it's actually, there's some SARs within that sextuple that are more close to each other, and that's what you want to focus on. So of course, I know this is the 1 minute where I don't extend, but think of this if this was on the 15-minute or 30-minute or 1 hour, that is how I would interpret that sextuple. So instead of having a sextuple, I would have a triple and a double.
So the stop loss. So the stop loss is how you look at the distance. So if we've got a 30 pip stop loss on gold, so
yeah,
the area that you look for, like how can I say, the distance between the SARs would be like 30, within 20 to 30 pips, right?
The distance for the SAR should be within 10 pips. So the distance between the SAR should be 10 pips. My stop loss is the one for gold that's like 30 pips.
Okay. From the SARs, right?
No, just general. So that's why I normally say, so let's assume, and I know here it didn't happen, but let's assume there was a trade here, a valid trade here, because I can see a double SAR on gold on the hourly. So let's assume there was a sell entry on gold right here. And this is just assuming. So let's assume this candle was a valid sell on gold. would I have taken this? So this is a double SAR. The top SAR is 1873. The bottom one is 1873.5. The bottom one is 1871.8. So that is like 12 pip zone. So that's fine for me as an SAR. So remember, it's not a static 10 pip zone. Sometimes, you just have to analyze and see what makes sense. So for this one, let's just assume this was a valid sell. So this is not a sell I would have taken. So again, my stop loss is 30 pips. Not to say that you can't increase your stop loss, not to say that you have to have a 30 pip stop like me. But the idea here, once a trade validates, after whether it's a break and continuation or test and rejection, once that trade validates, whatever your stop loss is, make sure your stop loss is above the SARs you're trading at the very least. So that's it. It doesn't have to be 30, but just make sure it is above there. So for me, it's just a static 30. That's how I trade. So for me, if it's 30, instead of entering on impulse, I would wait for a retracement up there in order to make sure that my stop loss is above that zone. And then I would then drop down to the 1 minute or 5 minute and wait for a retracement and get in the trade on the 1 minute and 5 minute. But ideally the idea here is make sure your stop loss is above the SAR, maybe even better, stop loss above the previous high low.
So after so on the third candle, you wait for the retracement. So you wait for the retracement on the third candle, and
so after a trade validates, wait for the retracement on the third candle, but on a lower time frame. So if I was trading the hourly time frame, of course, the third candle can give me a retracement. It doesn't have to be. We've seen where trade goes straight into profit. But on the third candle, I go down. If it's an hourly candle, if it's a 4 hour, on the third candle, I will go down to the 1 minute or 5 minute entry. And because right here, if I were to go down on the 1 minute and 5 minute, this zone would still be marked up. So the same thing for this US 30 trade that we got laid in on this morning. There was this 30-minute zone right here, this zone, because we had a break and continuation. So this is a perfect example of what you're asking. So this was the entry right here on US 30. 500, 50 pips TP, 100 pips, 50 pips stop loss, 100 pips TP. So that was the trade right there. This trade, if you entered on impulse, this trade would actually have been at break even because the trade would have given you 50 pips profit. I think it did. Yeah, would have given you 50 pips profit, and you'd have set break even, and then you'd have gotten taken out of this trade at break even if you entered in on impulse. But during the live session, like for me, also, even with my 50 pips stop loss, my stop loss would not have been above this SAR. So think of it the same idea with gold or whatever. The trade validated, but my stop loss wasn't above the SAR zone. So which is why for me, I preferred to wait. And then I came down to the 1 minute. So of course I stopped extending my SARs right here, came down to the 1 minute. And then I look, so you see, I came down to the 1 minute, but the zone is still there. So I know what zone I'm trading on the 30 minute. And then here, what I was looking for was a break and continuation of a live sell SAR. So this was the trade right there. So the trade had already validated, but because because if you guys have seen, these people have been faking us out, like literally, God, US 30 is dumping. These people have been faking us out a lot. So the idea for waiting for a retracement is just saying, I'm willing to, if this trade goes to full TP, well and good, I'm not going to feel bad about it. But if this trade stops me out, I would feel bad about it if I knew I had the opportunity to wait for a retracement and for another entry. So, this year, waited on the 1 minute, we got that break and continuation of a live SAR, and this was the trade that we missed this morning, and it would have gone straight to TP. So instead of getting taken out at break even, you would have had a winning trade, no drawdown. So same analogy, whether it's gold or whether it's EU. And for this one, this is that 30-minute zone, this one down here. And you see for this trade, my stop loss is above even the live SAR, and my stop loss is above the 30-minute zone that I'm trading. So that aligns to all the rules that I have, if that makes sense.
Yeah, but the thing is, the second candle, how far should it, like, how far does it have to close from the SAR for us to go down to the 5 minute? I'm still like a bit confused.
So you so your stop loss will always give you that answer. So if the second candle, the ideal which we had that ideal entry, I think last week, but even for that we got faked out. The ideal validation, the ideal closure for that second candle, which is the one that gives you the validation, is if we go back here on the 30-minute, the ideal entry here would have been if this one, and I can look for a better example. The ideal entry would be if this 30-minute candle had closed next to those SARs. That is the best setup you'll have for an SAR, because that one, you don't have to go down to a lower time frame. You can enter in on that impulse, whether it's on the 1 hour, whether it's on the 4 hour. That is the ideal entry. But the further down the confirmation candle closes, the further down your stop loss will start moving away from your SARs. So I normally say, if the distance between your entry and the SARs you're trading is like 70% of your stop loss, wait for a retracement.
Yeah, so this okay. So 30 pips stop loss. So on US30 we use a 50 pip stop loss. So
Yeah.
the thing is, this validation candle, when it closes, let's just say it closes too far away. So like how far? Like, I know we said 70%. Like how far would that be then? Like 60 pips?
This is a good example right here. So you see, this is a break. This here is a break. This is a continuation. So when this trade validated, look at where the trade was. The SARs we are trading are literally like 100% of our stop loss. So this is a red flag.
Oh yeah.
So So if you set up, so if you line up, once a trade validates, put in this long and short tool, and it will literally tell you visually. So you see, for this one, when this trade validated, look at where our stop loss is, look at where our SARs are. So our top SAR is literally like 110% of our stop loss. So for me, that's not a risk I'm willing to take. As much as you will have trades that validate even when your stop loss is 110 or the SARs are 150% of your stop loss, and they will still go to take profit. But are you willing to take that risk? For me, I'm not. So when a trade validates, I normally line up this tool. And so let's say even this 30-minute candle lined up here. So yes, my stop loss would have still been above the SARs, but you can see the distance between my entry and my SARs is like 60 or 70%. So this one would still have been a risky setup. But remember, the key thing is always make sure that your stop loss is above your SAR. So your stop loss can be above the SARs, and the stop loss can be 70 pips, or the SARs can be 70 pips away from your entry, and the trade can still be valid. So for example, you see the trade I've marked up right here. So let's assume this 30-minute candle closed somewhere above here and our trade validated here. So as much as the SARs are like 70% away or 60% away, actually this is close to 90%. SARs are like 90% away from where the supposed entry would be, but the overall stop loss is above the top SAR. So this would be a valid trade. So if you ask me, if you gave me two types of trades and told me you don't have an option of waiting for a retracement, which of these two trades would you take? Would you take any of these trades? And don't say that I would wait for a retracement. So you give me this first trade, that one, and this one was a valid trade. You give me that trade, and you give me another trade that's right there. So we are just assuming that this 30-minute candle closed above here. I would say, okay, and both trades are valid. I would say I'm not gonna take this because, of course, it's far away from my SARs, but I'm not gonna say, you told me not to say, I'm gonna wait for a retracement. So here both trades are valid, but here, what rule am I sticking to? I'm sticking to the rule that says make sure your stop loss is above the SARs. So that's the basic rule. So here I'm like, okay, is this stop loss above the SARs? No. So I'm going to say I'm not taking this trade. However, for the other trade is still valid. Okay, the trade is still valid. now for this trade, yes, the SARs are like 80% or 90% away from my entry, but does it satisfy the rule of my stop loss being above the SARs? Yes, it is. And then if you told me which of the two trades would you take, if you had a gun to your head, I would take this trade. If that makes sense. So always, the key thing is always make sure your stop loss is above the SAR. So forget about the distance. So first learn to identify where your stop loss is relative to your SARs. And then once you've back tested and identified that, then calm down and ask yourself, okay, for the distance, if I enter this trade here, as much as it's a valid trade, as much as my stop loss is above the SAR, man, US 30 is still tanking. As much as it's a valid trade, as much as my stop loss is above the SARs, am I willing to take the risk of hopping in a trade that the SARs are like 70% of my stop loss? For me, that's when then I come in and say, okay, you have three options. Take the risk and hop in, or wait for a retracement and go down to a 1 minute and 5 minute time frame, which is what I do. Or if you're risking like 0.75% per trade, which is what I do, and you really, really, really want to trade, enter in with half of what you would normally enter in, like a filler trade, or half the lot size. And then if the trade goes to full TP, guess what? You gain like 0.75%, and then you'll be like, okay, I was in the game. But if the trade comes back and retraces, you can scale in with the remaining 0.375 or 0.5 or whatnot. So it all, once you've so the first thing is to make sure you can identify, or make sure you can develop the discipline of having your stop loss above your SARs. And then after you've developed that discipline, then calm down and then say, which of those three entries or entry logics will I use after a trade is valid? Will I wait for a retracement? Will I take the risk and jump in? Or will I use half the risk I would normally use just to feel that I'm in the game?
Yeah, so in this trade, what you would have done is on the third candle, you wouldn't have entered. You would have
Yeah, so for this trade, I would have waited. So which is why I waited, and we actually got the entry during the live, like literally, we got the entry like 2 minutes before I hopped into the live session. Even for me, I was in another meeting, but even for me, I wasn't able to take that trade. But yeah, so for me, the first thing, if my stop loss cannot be above the SCRs that I'm trading, I will definitely wait for a retracement. No ifs, buts, or maybes. When I was starting to test this strategy, I definitely FOMO'd and lost a lot of money, but I didn't lose because the trade was invalid. I lost because my stop loss wasn't above those zones, and the trade literally came up, retraced up, faked me out, and then dropped back down. So that's the idea where I started saying I'm gonna wait. So when I started waiting for that retracement, I started having more profitability, and I stopped avoiding like 90% of the stop hunts.
Yeah, and with this strategy, the take profit, what's that based off of?
So the take profit is based off of the stop loss, right? So for me, I normally say with this strategy, have a 1:2 risk to reward. So 1:2 means if your stop loss is 30 pips, TP is 60 pips. If your stop loss is 50 pips, TP is 100 pips. But once you achieve 1:1 risk to reward, so if your stop loss is 30 pips and then you get to 30 pips in profit, that is a 1:1 risk to reward. Set break even. And if you want, you can secure some profit right there. For me, I normally don't secure. For me, it's always either stop loss, TP, or break even. But securing some profit is good. Yeah. But the key thing, the key thing is if you are at a 1:1 risk to reward, set break even.
Yeah. And when we go down to the 1 minute, when do you go down to the 5? Is that
so like you see today, I would have gone down to the 1 minute and 5 minute to wait for that retracement. So I go down to the 1 and 5 minute if the entry is the distance between my entry and the SCRs I'm trading is like 70% of my stop loss. So in this, even though my stop loss was above the SCRs, so sometimes I'll just, if I'm not trading with you guys, honestly, sometimes I just hop in on on impulse, but I never break the rule of my stop loss being above the SARs. So that is a major thing. Never break that rule of your stop loss being above the SARs, above or below, depending on what direction. Never ever break that. So sometimes for me, I'll just take the risk. If I'm not trading with you guys, honestly, and to be transparent, if I'm not on the live session, because for me, honestly, I don't want to be on the charts, because so long as a trade has validated for me and my stop loss is above the SARs, even though it's like 90% of my stop loss, I will just jump in and be like, and walk away from the charts. But if I'm online with you guys, right, I want to give you guys ideally, some good entries. But I will go down to the 1 minute and 5 minute timeframes if one of two things. So of course the trade has to always be valid. So no questions on that. The trade has to always be valid. So I'll go down to the 1 minute and 5 minutes only if the distance of my entry and SARs, or let me put it this way. One reason I'll go down to the 1 minute or 5 minutes is if the trade has validated and my SAR cannot be, my stop loss cannot be above or below the SARs I'm trading. So that's scenario one. The other reason I'll go down to the 1 minute or 5 minute time frame is if the trade has validated and yes, my stop loss can be above the SARs I'm trading, but those SAR, the distance between my entry and the SARs is like 70%, 80%, or 90% of my stop loss. And that way I know, okay, this one I can get faked out and the trade comes back into profit. So those are the only two scenarios I'll go down to the 1 minute or the 5 minute. So once a trade validates, that's when it will tell you whether you're going to go down on the 1 minute or 5 minute. So the trade can validate on the 4 hours and then it validates literally next to the SARs. You have no business going down to the 1 minute or five minutes because that's the perfect SAR entry. But the trade can validate on the 4 hour and, because 4 hour and 1 hour candles can be huge. And then your stop loss cannot be above those SARs you're trading. And then at that point, you have no option but to go down to the 1 minute and 5 minute and wait for that retracement.
All right.
So think of it as the power of three, right? Accumulation, manipulation, distribution. So the idea, so think of the SAR as, and even when we start using the EA, think of the SAR as, in trading, it's always a probabilities game. Is there a strategy that can tell you with a significant which is why I do not like people who use guarantees in trading. Even all these people who offer services out here and say guarantee, I do not like, because nothing is guaranteed. So always ask yourself, do you have a strategy that can, with a reasonable probability, tell you gold is going to buy, US 30 is going to sell? For me, the SAR is that. The SAR is like, for me, the SCR setup is, I think of it this way. It tells me with like a X amount of probability, maybe 70%, maybe 80%, that US 30 is going to sell based off of this SAR. So my job and your job is to find the perfect, not perfect. My job and your job is to find an entry that avoids you getting stop hunted, that avoids you over leveraging, that avoids you forming into trades, because the SAR has done majority of the job for you. It has given you a probability, a high probability that X commodity or X instrument is going to buy or sell. It has already done that for you. Your job is to then find an entry. And again, I do not advise trading without a stop loss. Since I developed those entry rules, for me, I always have a stop loss. Of course, one probability can be, okay, if the SAR is telling me with an 80% probability that gold is going to sell, I can sell gold and not have a stop loss. That is one way to think of it. But for me, I always have a stop loss. So your job is to find an entry that avoids you getting faked out, if that makes sense. I don't know if you're still in here. I think you disconnected. But anyway, let me know if you have any other question. But that's your job. The SAR gives you with with a high probability that a certain instrument is going to buy or sell. Your job is to find the entry. I know, Audrey, you said EU. What is it? The daily or what? So EU. Audrey, let me know if it's on the 15-minute or 30-minute. But here EU, there's this double SAR on the 30-minute. But honestly, I don't want to sell. I don't want to sell EU. EU has been dropping. If this thing's reverse, EU has been dropping. So EU, I don't see anything on the 30-minute. I don't see 15-minute. We have this triple SAR right here. The only thing I can see would be a break and continuation. So if this candle closes below here, and then the next candle closes below here, that would be a sell. But based off of how EU has been dropping, honestly, for EU, I'm waiting for buys because this thing has been trending down for 2 months. But anyway, my best is still a sell, but I don't think I'll take any sells for EU. And also it's an FX pair. I think if I were to take a sell for EU, because for me, the sell for FX pairs, I normally do like 25 pip stop loss and 50 pip TP, or like a 30 pip stop loss and 60 pip TP. So here, if I was to sell EU, you can see the kind of move it would have to do.
It works.
Huh?
Oh, no, sorry.
So for me to do an EU move, I'll probably do like a 15 pip stop and 30 pip TP. Yeah, but EU, yeah, but it hasn't even validated on the 15-minute.
Wait, so you know, GU moves the same, doesn't it, to EU?
Yeah.
GU.
Yeah. Ideally, they should, but not always. Because keep in mind, as much as they're pegged on the US dollar, that's the British pound and the euro. So if something happens in London and right now, or in Britain, and right now the Britain is off of the EU, like you can have an instance where GU is pumping and EU is falling, right? Because as much as they're pegged to the US dollar, they're both separate independent currencies. So they don't always move the same. Yeah. All right. Any other questions? So unfortunately today, no trades. Hopefully we'll get something tomorrow. Oh. All right. Any last questions?
No. See you tomorrow.
All right, guys. I'll catch you guys tomorrow. Bye.